Welcome to TMS Insights. Jeremy Hook and Ben Clark bring you this edition for June as we have been through what was, I guess, a period a lot of people weren't expecting. A good month in May and a good one in April. Ben, the market's recovered from a poor start to the year.
It certainly has, and despite all the negative headlines and being told to sell out all your shares at the start of the year, the market's actually put in a pretty decent performance. And I think one of the game changers of late has been that rate cut from the RBA. It took the market by surprise, which is rare in terms of rate movements, and we've seen a bit of buying in some of those yield sort of stocks again. And a lot of fund managers, I think, at the moment are sitting on quite high cash levels, and if the market can hold up through to the end of June, you might find that cash starts to get pushed in.
Yeah, because often they all reposition for July as the new mandates come on. So that tends to be often a good little period in the market. Obviously get a lot of bank dividends coming through as well, which is great. Maybe we've got an unusual time. We had that rate cut, which, as you mentioned, was a real catalyst for the market's improvement through May. But it's an election. Now, a lot of people don't understand how this can be quite a non-event for markets overall. Expectations are that they can be really significant. More than anything else, the markets like them to get done with and get on with the business of making money.
Right, absolutely. And it's probably the uncertainty in some years can be something that rattles the market. But I think a lot of the major sort of policies are getting closer and closer in terms of Labor and Liberal, and there's nothing that really jumps out to me that's going to sort of worry the market from that perspective. Probably the US election might be something we all focus on a bit more in time. But look, generally, Jeremy, it's been there hasn't been a lot of company announcements in the last few weeks. The volatility's really dropped off.
Yeah,
it feels very quiet.
Has. And that's definitely something. I mean, it is often that May into early June period where you get profit warnings. We certainly had some, but not a lot really. And what that really belies is the fact that the economy is not nearly as bad as a lot of the front pages of papers would like you to believe. Unemployment's low. We've got economic growth, building approvals are strong. There are parts of the country that aren't doing as well, obviously, but overall, the corporate Australia is in reasonable health.
Yeah, I think so. And I think, again, there is a lot of pessimism out there, and I often, the last couple of years, it sort of confused me a bit. Australia's the third fastest growing economy in the world. And if you strip out China, it's the second fastest growing economy at 3.1% GDP growth. Rates are low. House prices are well bid in in the eastern states, and I tend to think that you speak to some businesses, they're feeling pretty optimistic about how things are going, particularly in New South Wales and in Sydney.
Yeah, no, definitely. We always get a different feel when we talk to the CEOs and CFOs who run the companies that we invest in, and that's good to hear. And that's what we're really focusing on now. August isn't that far away, but that's when the company full year reports will come out, and we've got an eye to those. And in particular, probably now to maybe mention a couple of stocks that with the volatility look good to be investing in. And the first one I think we want to mention today is Blackmores, which has been a very big run up through the 2015 period, and then so far this year it's pulled back a long way. And again, some of the moving parts make it a bit volatile in a share price sense, but $140 roughly a share at the moment, attractive levels.
Yeah, I think so. I think I was a little bit sceptical about the vitamins sort of. Well, I almost saw it as a bit of a fad, but we went and met with the company and met. We're very impressed with management. I think fair to say is a lot of people who have got in front of management have reported, and probably underestimated, how big a growth market this could be over coming decades. Really, as the Chinese have been taking herbal supplements for thousands of years. They truly believe in them. The infant formula scare that they had a year or two ago now has, I think, seen them totally discount the locally produced products, and the figures that Blackmore show is that New Zealand and Australian produce is seen as the most desirable by the Chinese. And of course, what's happening at the moment is the Chinese government is regulating the various sales channels that Blackmores and competitors sell their products through.
And this was the issue that affected the share price pretty heavily through May, wasn't it?
Yeah, absolutely. And really from the start of the year, I mean, Blackmore's got up to nearly $220 a share. And in hindsight, that was warranted. But you look at the numbers now, trading on under 20 times earnings, a forward dividend yield of 5.7%, including franking credits. And the third quarter sales showed 65% sales growth and 160% profit growth. It looks cheap. Return on equity is in the
60%,
50s.
yeah. It's very high return on equity, and the earnings growth is there. So what appeared high PEs are certainly coming down a long way. But a good stock, it's done very well. It's just when does price meet the right level, and we're thinking it's approached that level now. So that's certainly a good one, and good one for people to look at and talk to us about buying in the right way. So that's important. Another one is a slightly different company, again going from a $145 share price to an 87-cent share, but iCar Asia is a really interesting business, Ben. One we've watched for a while, and we think now's a good time to get into it.
Well, I think you were onto iProperty pretty early, and the thing that's probably given me a fair degree of belief in this business is the fact that it was born out of the same stable, built by a similar founder and management team. And, it is hard to track, what is the number one car website in Malaysia. But I think after REA took their stake in IPP and did extensive due diligence on it and ended up taking it out, you get comfort that the business has been born the right way and built the right way, and the people behind it are quality. And of course, what we're seeing is car sales going through the same journey with iCar, which has come a long way back from its recent high, and is quite well off where car sales last topped up their stake in in iCar. So
and revenues have been growing very, very well. 123% growth in revenues in their last quarterly update. They're not profitable yet. They will be expected to hit a profit in 2018, which isn't that far away. And again, that's the time of real interest leading into that tipping point where a company goes from a loss-making entity to a profit-making entity, and that we think might be a time when car sales could be interested in making something more of an equity interest in the business. But owning businesses in the high growth areas of Asia, Malaysia, Thailand, and Indonesia, each different economies, and the car markets are quite different. iCar Asia, for a smaller part of the portfolio, makes some sense.
It's probably not for everyone. Like, it is speculative. It isn't a business that has the real fundamentals behind it yet. No. But I think you're not buying it on a hyped up price.
It's not hot air, no, that's for sure. And again, the price meets something sensible. So Ben, coming up now, again, June, election slowing a little bit of the corporate activity up, but July 2 comes, we're going to be busy, and all the analysts will be beginning to start thinking about full year results.
Absolutely. And that's, I think the key time when fund managers and also clients should be thinking, what do you want to own going into reporting season? One trend that hasn't changed is how severe the market has dealt with companies that have disappointed. And you want to be, in businesses that you think of, no one knows for sure, of course, but have got a high degree of certainty about their earnings, and that they're going to deliver a result in market expectations. And looking out for some opportunities coming to that time, because we are also reasonably cashed up at the moment across clients generally, and that's the reason for it at this time of year.
Definitely, and we're quite busy here behind the scenes doing quite a lot of work around the end of financial year planning, whether it be contributions or the pension drawdowns, as everybody's client situations are different. But do get in touch with us if you've got any questions. It's often a busy run into June 30, and we're here to help you in any way. We'll be back. That's all today, Ben.
Yep.
Thank you, and back after this, after today's session for July TMS Insights. Thank you.